Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. We begin this hour with stocks lower, adding to 3 days of losses as President Trump says levies on Canada and Mexico are moving forward on time, on schedule. Joining us now is Sharon Bell of Goldman Sachs. Sharon, welcome to the programme. Given the re-rating we've seen on European equities over the past month or so, how vulnerable are they to a tariff hit over the next month?
Yeah, I mean, I think, as you see on your screens now, that everyone is a little bit vulnerable to upping uncertainty again. We clearly don't know what Trump will do when it comes to tariff plans. Even for Canada and Mexico, will they restart again? And is the tariffs that he's talking about sort of a negotiation tool or something that he plans to use permanently? So it's a lot of uncertainty. I think that's extremely unhelpful for growth, unhelpful for inflation as well. But you're right, European markets have done very well this year, but I don't think that's necessarily related to tariffs. I think it's because the valuation gap to the US have just got so large, and European companies are benefiting from a view that maybe there'll be peace in Ukraine, maybe we'll have more fiscal spend from Germany, for example.
Well, that was really the question. Is it just a low bar, or are there shoots, signs that maybe in Europe there are going to be some moves to engender growth? How much, Sharon, are you seeing some of those hopes come to fruition with the latest information about the possibility of expediting some sort of amendment in Germany to get some extra military spending?
So I completely agree that Germany absolutely needs to spend more. Germany is one of the very few places in Europe where debt to GDP is not extremely stretched. And that's because of the constitutional debt rate really having prevented a rise in levels of debt in recent years. So their deficit, their debt, it certainly could be expanded. Now, why would they do that? Because growth has been so weak. We just again had weak growth numbers out of Germany. We know that a lot of industry has been reducing its exposure to Germany. We also know Germany needs to spend more on defence. So I do think, I mean, exactly what guise it takes, it's difficult to know, but I do think the new German administration, as it forms, will be looking to spend more, both on infrastructure, spend in Germany, but also on defence as well.
Sharon, I got to say, this is one of the most confusing markets to try to understand from a macro perspective I could possibly imagine, let alone the tariff uncertainty, let alone whether Germany starts to spend more. There's a question of what this means for interest rates in Europe and how this rebounds into stocks. The consensus heading into this year was that European rates, the ECB, would be cutting rates more aggressively than in the United States. Now you have a potential growth shock in the United States, or the fear of one. And in Europe, you have the potential for more fiscal spending that actually is sending yields, at least yesterday, marginally higher. How does that factor into the bullish call on European equities?
Yeah, I think in the case of Europe, you're talking about more fiscal spend in an environment of pretty much no economic growth. So it's really to boost infrastructure, reform the supply side of the economy, get growth and productivity improving. I don't think in and of itself it's going to be hugely inflationary, given that you've got other disinflationary things going on. For example, the labour market loosening a little bit. If there is peace between Ukraine and Russia, you may see more energy supplies into Europe. So I think the ECB will be looking at all of those things. We do expect them to be cutting every meeting, just given how weak economic growth is.
Sharon, given where we have the Trump administration and their policy perspectives, you talk about in your note this idea for deregulation, driving of growth. We've heard this from a number of European leaders, but is the rhetoric actually matching what you feel on the ground in Europe and what may be beneficial for equities?
Yeah, I think there are some big levers you can pull in Europe. One of them is for Germany to spend a bit more fiscally on infrastructure. Another one is potentially try and bring down energy prices, getting more gas supply into Europe. Another one potentially would be some deregulation. Europe does have more regulations than you see in the US, or you certainly hear companies complain regulation levels are extremely high in Europe. But it does take a long time to move that. And you've got a lot of of different countries with different incentives to regulate. So I'm more sceptical about that one. I feel that more spending on fiscal and defence by all countries in Europe, but especially in Germany, and maybe lower gas, are really the things that are going to move the needle for Europe this year.
We have the UK Prime Minister Keir Starmer coming to Washington this week. He's going to be meeting with President Trump. The two have seemingly had somewhat of a good relationship, having a number of meetings. Do you think there's an investment case for UK outside of the EU right now, especially if they can get to a comprehensive trade deal?
Yeah, I mean, the UK's got some advantages. One advantage, ironically, is it's not a large manufacturing economy. It's mainly in services. It's not that exposed to, therefore, tariffs. And Trump has already said that the UK is not a special target, either of those tariffs. So given those things, the UK is probably less vulnerable to the trade war, to the tariff risk, etc. But it is nonetheless a small, open economy, and it will have some vulnerability to all of that. So I think that's one helpful point on the UK. The other helpful point on the UK, again, is if you did see ultimately a ceasefire in Ukraine, if you ultimately saw gas prices come down, the UK, and particularly the consumer in the UK, is very gas dependent. So those things would certainly help. So there are some elements that could be better for the UK. And the final point on this is the UK indices, stock markets, are on a particularly large valuation discount to the US, even more so than the rest of Europe. So again, that may look attractive.
Sharon, just want to wrap it together with a sense of what your highest conviction trade is. After you got it right to start this year, the idea that Europe would outperform U.S. equities simply because of a valuation gap. Is that trade done, or are you leaning into that?
Yeah, this is number one question that I'm getting from clients really at the moment. This is what investors really want to know. Can European outperformance persist, particularly given that we've seen all this before, haven't we? Europe has been a long-term perma underperformer. Every now and again, of course, it has pops of good performance, but will these last? I think this one could be a little bit longer, just because you've got this huge valuation differential between the US and Europe, and maybe it's closed a bit, but even adjusted for growth, which is lower in Europe for sure, we still find that Europe is on quite a big discount. We've had some institutional flows come back into Europe, but they're still quite minor compared to the outflows in the last few years. You do need the politics to go the right way in Europe, and the stuff we talked about before, more spending, etc. by Germany, more defence spending, etc. But yeah, I think there's possibly a little bit more to go.
Hey Sharon, appreciate your time. Sharon Bell there of Goldman Sachs on the latest out of Europe. Joining us now, John Lieber of the Eurasia Group. John, just to recap, and welcome to the programme, sir, as always. These are the proposals right now. Next week, 25% on Canada and Mexico. A week later, steel and aluminium. The following month, we're talking about reciprocal tariffs. John, just to recap your base case. What is your base case for what does and does not happen over the next month or so?
So I think that April 1st deadline is the really important one to watch. There's a bunch of investigations directed across the entire government that will be coming out on April 1st. The reciprocal tariffs that were just talked about, the unfair trade practices of America's many trade partners, and I'm sure that we'll see some allegations against countries like Vietnam and Japan and Germany all coming out on April 1st. And then that is going to kickstart a process which eventually will lead to higher tariffs on quite a few of these countries. But in the meantime, this negotiation is going to be ongoing. So, over the next month, you listened to Trump last night. He was responding to a question from a reporter, and he started talking about Canada and Mexico, and he ended up talking about reciprocal tariffs, which are much broader than just Canada and Mexico. So I'm not sure, the president has a way of weaving when he talks, so I'm not sure we necessarily could take this as real guidance as to what's going to happen next week. Our view is that those broad tariffs on Canada and Mexico are likely to be avoided because the two countries are doing enough to avoid them. But April 1st remains the real day to watch because of these other investigations, and the sectoral tariffs are probably going to end up being more meaningful for the North American countries than these broad tariff threats are.
It was a question from our own Jordan Fabian, and in the president's response, this weave, if you will, he did talk about the fact that the agreement under place now is not working. But that deal, USMCA, was negotiated when he was the 45th president. What doesn't he like about USMCA right now that he's so willing to put 25% tariffs on Canada and Mexico?
The grievances on USMCA, I think, are relatively narrow and specific, and I think they have to do with China. Everything else about the USMCA, there hasn't really been any controversy about its implementation. There was an energy case that was brought against the Americans. There was a case brought on some labor issues in Mexico. There's been a few other disputes that have been brought, but they've all been working basically as the plan was sketched out. I think the American grievance here is about Chinese goods in the Mexican supply chain. But of course, because it's Trump, they're also using the threat of tariffs to broaden it out on issues like fentanyl and immigration. So I have not heard the administration lay out a reasonable case of what exactly is broken in USMCA. The Mexico point's an obvious one. You can raise North American content requirements, but it really seems like Trump is using the threat of tariffs to leverage this for other policy goals.
Well, behind the scenes, our reporting is that the Trump administration told Mexican officials they should put tariffs on Chinese goods coming into Mexico. They're concerned about Chinese goods getting through the border. John, is it your base case then Trump is in negotiating mode when it comes to the tariffs due next week?
Yeah, I mean, yes, but I don't think it's about the China issue is going to be settled in the USMCA review, which is not due till the middle of next year. But all of this is happening in the background of that review. They want to force changes to Mexican law, and they want to force changes to USMCA that will make it harder for Chinese goods to get in the supply chain. That, I think, is the context for all of these things. In the near term, though, Trump is trying to fight over these unrelated policy issues that really matter to his political agenda: immigration, fentanyl, crime, the whole suite of issues with Mexico.
John, chaos may be the point. It might be the strategy that Donald Trump uses to try to break through and get some change. At the same time, that kind of chaos is creating uncertainty in C-suites at companies. You're seeing that in some of the earning expectations going forward. How much are some of the rank-and-file Republicans in Congress right now getting concerned about that?
I think there's quite a bit of concern. And right now, I think that the focus is on economic policy is around the budget, and it's around extending the Trump tax cuts at the end of the year. The real issue that's causing concern in Washington right now among Republicans is Trump's approach on Ukraine, which seems to be taking the Russian position. And that is causing quite a bit of consternation and is taking up a lot of the oxygen in the room. But when it comes to the budget cuts and DOGE, I think these issues actually have quite a bit of support among Republicans who continue to look at this deficit challenge that the U.S. has and see it as a generational issue that there's no real solution for because they're not really willing to raise taxes. So the spending cuts, despite the uncertainty, are relatively popular. I think the tariffs everybody in Washington could do without, except for Trump and his team. But this is just the reality of what happens when you elect a tariff man as president.
John, you said that the pivot toward Russia has gotten a lot of attention among Republicans. What's the explanation for it? How are people understanding it?
I think the president is, wants to end the war, is susceptible to has a relationship with Putin, is susceptible to the Russian message on Putin, on Ukraine, and is sympathetic to what's coming out of Russia right now. And I think that that's a pretty disturbing explanation. I don't know if there's a better explanation for it, however.
John, appreciate your perspective as always. John Lieber there of Eurasia Group. Ives of Wedbush joins us now to extend the conversation. Dan, Barr down and down hard. Are the ADRs out of China listed in the United States? How investable are they?
I think look, Lisa hit it. I think Baba oversold here. I mean, look, there's going to be some fear factor, but when it comes to cloud, when it comes to who's going to be the winner in AI in China, I think names like Alibaba, those are names that you own here. So I think Barr's going to be a little worse in the bite here. I think that's actually the best reaction that we're seeing in China in terms of some of these names.
They're two different things, though, Dan. The idea of buying in China if you are in mainland China versus buying the ADRs in the U.S. at a time where there is increasing focus on whether some of these companies should be raising money in the United States. Do you think that there will be an increasing divide between the depository receipts and what we see in mainland China or Hong Kong?
Well, I think there will be, just because the worry here in terms of, what could come out of Trump and the Beltway. And then I think the other focus is, even though we're hearing jitters and obviously going to Nvidia tomorrow, I think more and more investors would rather own big tech. Obviously, there's regulatory risk, but that continues to be, I think, at the top of the mountain when it comes to AI revolution.
Dan, Evercore ISI put out a note saying the sell-off, what's going on in China, is more about sell first and ask questions later. Given this directive from the president is just that, a directive. It's a place of travel where they want to go. How much of this do you read as leverage for some sort of deal potentially Trump might want to do with Beijing?
Look, I was just in Hong Kong, over the last week. I do think that this is all a game of high-stakes poker to ultimately where you get to some sort of deal. Look, I think, given the movements, I get it, but I do think that you're going to get to maybe a lot better outcome here between U.S. and China. That's the thinking. I think especially in Hong Kong and a lot of investors there, rather than maybe some of the onerous or draconian scenarios that you would have thought, going back to when Trump got elected.
How concerned are you, though, that there are conversations already underway between Trump administration officials when it comes to stricter export controls, similar to what we saw in the Biden administration, but actually even maybe a little bit sharper?
Look, it's all going to be this fine line. And just even think about things like TikTok, right? I mean, that's another chip on the table, just like China has chips as well with Tesla and FSD. Look, this is all going to be in negotiation. But I do believe that there's going to be this balancing act. I don't think this is going to, what I view as like draconianly impact chips, the supply chain, despite maybe some of the fears out there. And I think that's also why he talks to Jensen, talks to Cook, of course Musk, with a front row seat, in terms of this very tricky balancing act between acting tough but not ruining this, what continues to be, I think, the biggest tech transformation in the last 40 years.
So, Dan, one reason why I love speaking with you is because I never know where you're going to be. Today you're in Kuala Lumpur. You travel around the world. I'm not sure if you're in a yacht, but I am curious about what you're hearing from people around the world when we see some of the uncertainty coming out of the White House. How seriously are people taking that internationally as they decide which tech giants to invest in and how much they can really be confident in the American tech prowess story?
Yeah, I mean, listen, I'd say every meeting in the last 2 weeks, regardless of what city we're in across Asia, it starts off with that. In terms of Trump, what does it mean, especially a lot of these countries that's gotten crushed, in terms of worries about the ripple effect, in terms of data centers, CapEx, regulatory, and what that means. Look, I think it's just another risk investors are trying to handicap, but a lot of it really just does come down to fundamentals. I think if fundamentals continue to kind of drive, and I believe we'll see it from Nvidia tomorrow, I think some of this stuff does go to the background. But no doubt, it has been white knuckles to start the year, just given you don't know what's going to come out from a regulatory perspective in terms of this U.S.-China cold tech war.
Dan Ives in Malaysia this morning, or this evening. Dan, appreciate it. Dan Ives at Wedbush. Dutta of Renmac raising concerns on the labour market, writing much of what we see in the financial press, tariffs, uncertainty, is a red herring. An ex-post rationalisation for an economic slowdown that was already in motion. For the economy, expect conditions to deteriorate further in the jobs market. Neil joins us now for more. Neil, welcome to the programme, sir. As soon as you hit publish yesterday, we talked about that note. Fantastic read. Neil, just share with us why you think this is a train already in motion. It's not about the last month.
Well, John, I'm beginning to have second thoughts already because I see Anne-Marie rocking Fendi on the program, so it must be a bull market, no?
Vintage.
Someone's spending, Neil. She says it's second-hand. I don't know if it is.
Sure. No, all I'm doing, John, is just applying the playbook from late 2022 when we made that no-landing call. Remember, if you recall, it was basically four things: real incomes, housing, government spending, and this the way the consensus was positioned, right? So you fast forward to today, real incomes are slowing as the labor market continues to cool. The housing market is getting worse. Even though the Fed had been cutting, state and local governments are pulling back. The Doge gets all the attention, but really state and local government spending has been a meaningful tailwind to growth, and that's likely to go the other way. And if you look at the consensus, I mean, back in late 2022, everyone was positioned for, essentially recession. I mean, people held on to that view, believe it or not, through the middle of 2023. So one of the ways, it works is through an element of surprise, right? I mean, if everyone expects recession and it doesn't happen, you have to have this sort of period of catch-up. By contrast, if everyone is expecting things to be fine and then they're not, that could, prompt a clearing out of inventories, hiring, investment, and so forth, and kind of create a negative feedback loop with the economy. So that's kind of what I'm concerned about. The data hasn't been particularly encouraging of late, and I'd expect that to continue until the Fed gets on the right side of the eight ball.
Well, Neil, let's talk about the Fed. We all said yesterday, what's worse than a slowdown? And it's a slowdown the Fed's not willing to respond to anytime soon. Now, the Federal Reserve was willing to get ahead of something last year. They dropped rates by 100 basis points across 3 meetings. What changed coming into 25?
Well, I mean, they're basically taking out an insurance policy against the new administration. That's basically what happened. I mean, if you look at the adjustments to their risk assessment around inflation, the notion that they're simply innocently responding to the inflation data, I think, is a bit ridiculous. The upside surprises on inflation that we saw in the back half of last year paled in comparison to the upside surprises we saw in the first half of last year. And, the risk assessment didn't change all that much. So, to me, this kind of feels eerily similar to the period between June 2024 and September 2024. We went, if you recall, I mean, the Fed basically went peak hawkish in June, and then 3 months later, they're cutting 50 basis points. So I think where I'm at right now is the Fed is waiting for permission from the markets and the data in order to respond. And that's essentially tempting fate. I mean, if you're waiting for something bad to happen before you move, chances are something bad will happen. I mean, what changes the trends that we're seeing at the moment?
Well,
absent some kind of Fed response.
Well, but Neil, I think that a lot of people are picking up on the same thing that you are, and suddenly the idea of tariffs is no longer considered so inflationary, and it's considered more of a growth shock in the absence of some other pro-growth measures. Right now, it seems like the bond market is turning around to your side. Now we've got 2 rate cuts being priced into the market through year end. Is that enough to make you more positive if the Fed does go through with a 50 basis points of rate cuts by the end of this year?
No, not really. I mean, I think the Fed will need to do more than what's priced because the economy is weaker than they think. It's really that simple. I do find it kind of amusing how everyone is basically using tariffs and policy uncertainty as a rationale for their forecast adjustments now. I mean, to me, it's a bit rich, as if, if you thought that, I mean, why didn't you make your changes back in November after the election? It's not, I mean, the guy ran on tariff being his favorite word in the dictionary, and now you're surprised that he wants to go through with it? I mean, it's crazy.
But hold on a second, Neil. But let's just be clear. It's not just that he's going through with tariffs. It's, as John has mentioned many times, the sequencing of it, that there isn't a clear path for some of the offsets with respect to the tax cuts and the pro-growth measures, and you're not seeing the boom in deal activity. That's the reason why people are focusing more on the growth hit from tariffs than they are inflation, no?
No, I mean, I think what I'm seeing more is people talking about policy uncertainty related to the Trump administration, and that's why they've gotten cautious all of a sudden and why there will be a freeze in sort of investment and so forth. I mean, to me, it's ultimately demand that's going to be driving the discussion, and household demand is slowing because the labor markets continue to cool. The tariff stuff, I mean, again, this is all just sort of ex post thinking. I mean, uncertainty would be high if the shoe were on the other foot, right? Because we'd have one of the largest tax increases ever, potentially, at the end of the year. You don't think businesses would be worried about that? So it's just sort of like this heads I win, tails you lose type of analysis that I think is a bit ridiculous. I think everyone should just focus on the here and now, including the Fed. Instead of trying to take out an insurance policy about what may happen or may not happen, I mean, Congress is very evenly divided. I mean, the sort of fiscal expectations that people had baked in after the election, you could pin that at the feet of Congress, right? I mean, so it's not just the Trump administration from where the uncertainty is coming from, but I think it's wise to just focus on the here and now. And what the here and now tells me is that demand is slowing down, housing is still weak, and inflation is likely to continue to moderate as rental inflation keeps cooling off.
He knows his Fendi, and he nailed it at the end there. Neil Dutta of Renmac. Neil, good to catch up. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.